Welcome to the channel. Now, I know you're here because you're ready to grow your wealth and make your money work for you. That's awesome. But before you throw your hard-earned cash into the market, we need to talk about something super important: avoiding costly investing mistakes. Look, I've been in the real estate game for years, and trust me, I've seen it all. And you know what separates the successful investors from those who struggle? It's not about luck. It's about having the right knowledge and avoiding common pitfalls. That's why, in this video, we're diving deep into the top 7 investing mistakes that I see people making over and over again. By the end of this video, you'll know exactly what to watch out for and how to avoid leaving money on the table. Let's get started. The first mistake I see people making time and time again is this: not doing enough research. It's like walking into a car dealership, picking a car because you like the color, and buying it right then and there without even looking at the engine. Would you ever do that? When it comes to investing, you absolutely need to understand what you're putting your money into. That means researching the company, its financials, its competitors, the whole 9 yards. Remember, you're essentially buying a piece of that company, so treat it like a serious purchase. There are tons of resources out there to help you do your due diligence. You've got analyst reports, company websites, financial news outlets, you name it. Don't just skim the headlines either. Take the time to really understand the company's business model, its growth potential, and any risks involved. The second mistake that can absolutely destroy your returns is emotional investing. Look, we've all been there. The market takes a dip, your portfolio turns red, and you panic. You start making rash decisions based on fear, selling low because you're convinced it's only going to get worse. Here's the thing: investing should be driven by logic and strategy, not your emotions. When you let fear or greed take the wheel, you're way more likely to make impulsive decisions that you later regret. Instead of giving in to those emotional impulses, stick to your investment plan. Remember why you invested in the first place, and focus on the long-term outlook. The market goes up, the market goes down, it's a roller coaster ride. But if you have a solid strategy and you tune out the noise, you're much more likely to come out ahead. Okay, let's talk about diversification, or rather, the lack thereof. This is one of the biggest mistakes I see beginners make, and it can be a real portfolio killer. Putting all your money into just 1 or 2 stocks is incredibly risky. Think about it. If something happens to that one company or that one sector, your entire portfolio takes a hit. And trust me, you never want to be in a position where your financial future hinges on the performance of a single investment. That's where diversification comes in. By spreading your money across different asset classes, sectors, and geographies, you're essentially cushioning your portfolio against major losses. If one investment takes a hit, the others can help offset those losses. Mistake number 4, ignoring those pesky fees. Here's a mistake that might seem small but can actually cost you a ton of money over time: ignoring fees. Look, I get it, those expense ratios and trading commissions might seem insignificant, especially when you're first starting out. But here's the thing: fees compound over time. Every dollar you pay in fees is a dollar that's not working for you, growing your wealth. And trust me, those seemingly small percentages can add up to a significant chunk of change over the long run. So, what can you do about it? First, be aware of the fees associated with your investments. Read the fine print, compare expense ratios, and don't be afraid to shop around for lower-cost options. Remember, even a small difference in fees can make a big difference in your returns over the long haul. This next mistake is one that even seasoned investors struggle with: trying to time the market. Everyone wants to buy low and sell high, right? Sounds simple enough. But the reality is, timing the market perfectly is incredibly difficult, if not impossible. Think about it. You have to be right twice. Once when you buy, and once when you sell. And even if you get lucky once, the odds of consistently timing those peaks and valleys are slim to none. Plus, every time you buy or sell, you're potentially incurring trading fees, which can eat into your returns even further. Instead of trying to predict the unpredictable, focus on what you can control: your investment strategy. Adopt a long-term mindset, ride out those market fluctuations, and trust that over time, the market tends to go up. Investing without a plan is like setting out on a road trip without a map or GPS. You might have a vague idea of where you want to go, but you're much more likely to get lost along the way. That's why having a clear investment plan is crucial. Your plan should outline your financial goals, your risk tolerance, your investment timeline, and your asset allocation strategy. It's basically your roadmap to financial success. Without a plan, it's easy to make impulsive decisions, chase returns, and lose sight of your long-term goals. So before you invest a single dollar, take the time to create a solid investment plan that aligns with your individual needs and circumstances. The final investing mistake we're going to cover is following the crowd. It's easy to get caught up in the hype when everyone is talking about a particular stock or investment strategy. You see headlines like, "This stock is going to the moon," or "Everyone's investing in this, you should too." But here's the thing, just because everyone's doing something doesn't mean it's the right decision for you. Remember, what works for someone else might not work for you, and blindly following the herd can lead you down a dangerous path. Instead of jumping on the bandwagon, do your own research, consult with a financial advisor if needed, and make informed decisions based on your own individual circumstances and risk tolerance. Don't let FOMO, fear of missing out, drive your investment choices. So there you have it, the top 7 investing mistakes to avoid. By understanding these common pitfalls, you'll be well on your way to making smarter investment decisions and maximizing your returns. Remember, investing is a marathon, not a sprint. It's about making informed decisions, staying disciplined, and focusing on the long term. And hey, if you found this video helpful, do me a favor and hit that like button, and subscribe to the channel for more investing tips and strategies. I'm constantly putting out new content to help you build wealth and achieve financial freedom. Thanks for watching, and I'll catch you in the next one. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and hit the notification